The presentation is broken into 5 sections. The macro overview, looking at the broad economic landscape, key trends and indicators that shape the macro environment. Our Fintech thesis, looking at the mega trends of the Fintech sector and the key drivers of growth. The industry highlights, a brief look at the significant events that have unfolded in the industry over the past recent weeks and months. Next is the Fintech performance, where we identify the subsectors within the Fintech industry, provide a comprehensive review of the sales, earnings, and stock market performance. And last is the analyst spotlight, where we outline 3 selected companies that stand out in the Fintech landscape as potential investment opportunities. So section 1. My overall thesis of the stock market currently is that we're in a cyclical bear market that is currently experiencing a cyclical bull market move. We're going to look at 4 market signals that support this idea. First, the yield curve steepening, which has been a precursor to recession. The extremely narrow participation in the 22-23 bull market. The weak banking sector that will be a drag on the economy with less credit creation. A weak energy market signaling lack of demand and slowing economy. So first, here is the yield curve chart. In orange, you can see the 2-year note. In blue is the 30-year yields. And what this is showing is, on the green line, it represents when the yield curve gets inverted, and on the red lines is when the yield curve gets uninverted. And typically, when the yield curve goes from inverted to uninverted, we have experienced a recession within 3 to 5 months of that period of time. The recessions are marked in this blue shaded area, and you can see that in 1990, it was 3 months after the yield curve uninverted. In 2000, it was 4 months after. In 2007, it was 5 months after. And just recently, we inverted the yield curve in March of 2022 and uninverted the yield curve just this last month. I believe this is signaling a potential recession going into next year. Point 2 is the lack of participation in this bull market by most stocks. The S&P 500 is up 24% since the October lows, but only 17% of the components outperform the average, and only 50% of those stocks are positive for the year. In the broader indexes, it's even worse. The Russell 2000 stock index has a year-to-date return of negative 4.5%, while only 1% of the 2000 stocks reached a 52-week high year-to-date. The index is also down 39% from the peak in 2022. In the chart to the right, you see the 3 sectors that drove the gains so far this year, and you can notice that they were these last 3 here: technology, consumer discretionary, and communication services that drove the bulk of the S&P 500 gains. These 3 indexes have, as the major components of all of them, Microsoft, Apple, Nvidia, Amazon, Meta, and Google, which have been the leaders in this tech boom. But you can also see that most of the others were just barely breaking even or slightly better for the year. Another way to measure the broad market participation is by measuring the number of stocks going up versus the number of stocks going down. In the light blue is the New York Stock Exchange cumulative advanced decline line, and in the dark blue is the S&P 500. I'll make a couple of points here. Back in the 2022 highs, you could see the index made a higher high, but the advanced decline line did not, and that foreshadowed the bear market that we experienced in 2022. More recently, in 2023, we had our July rally, our recent sell-off, and just recently, in the last 2 weeks, we've pushed back up while the advanced decline line in the broader market did not. The NASDAQ is even worse. This is the NASDAQ stock market in the dark blue, and the advanced decline line for the NASDAQ. You can see this came down sharply in the 2022 bear market, but even in the recovery, only a few stocks led the NASDAQ higher, and this is a very wide gap between these 2 areas. Another example of the narrow market participation is this chart of the Russell 2000. The index is down again 8% over the last year. With 2,000 components and an average market cap of $2.6 billion, this represents a very broad section of the economy in the United States. And you can see that we're closer to the 2022 lows than the 2021 highs. Moving on to my third point, the banking sector. Over the past year, all major banks are carrying unrealized losses on their U.S. government bond and bill portfolio. In my opinion, this will hamper any credit creation from their balance sheets as they're constrained, and they will remain constrained for some time. This is already starting to show up in the Federal Reserve's H8 weekly data, showing all types of loan creation this year declining over the past year, and commercial and industrial loans, the poorest performer out of the group. Switching to the energy sector, my last point, starting in November, OPEC has been constraining the supply of oil to the marketplace. And at the same time, the strategic oil reserve in the United States has been drained to significantly low levels, multi-year lows, to a point of having no effect on further supply effects in the energy market. But there is no sign of energy price recovery. As you can see in this chart, this goes back to before the war started. This is the Russian war in Ukraine, which had a spike in the markets. This was when the Saudi Arabians reduced production by 2 million barrels. And more recently, these are the recent prices selling off further. Typically, in any of these situations where several important geopolitical events and supply cuts have happened, typically that would have supported trending higher prices in an average economy. I believe this is showing a lack of demand in our economy. So to summarize my macro views, these four factors illustrate the underlying weakness in the economy, the lack of participation by most companies in the broad markets, and this will likely lead to a pullback in the first half of next year. My two potential near-term scenarios for the S&P 500 are here. In red, the more likely scenario is that we top out before the 4,600 area on the S&P 500 and start to roll over balance before making new highs up into the January-February timeframe above the July 2023 highs. My alternative count would be that we push higher now, we go past those July highs, we top out prior to January and start to roll over. But either way, I'm expecting a significant drawdown into the first half of next year. So I'm going to go to section 2, the Fintech thesis, and start talking about the Fintech sector. Fintech market is growing fast with estimates of annual growth rate of about 18.5% per year. The market is expected to hit $850 billion by the year 2030, and North America represents the largest market share at 36%. We've identified 4 mega trends that will drive the Fintech growth. Megatrend 1 is rapid urbanization, and the need for financial inclusion will continue to drive organic growth of the industry. The UN estimates urban populations will increase 78% by 2050, while the World Bank conducted a survey in 2021 that claims 24% of the adults are unbanked. Fintech solutions will be a viable way to reach these new markets when traditional banking infrastructure is too expensive to serve these markets efficiently. Megatrend 2, millennials and Gen Z, our digital natives, present a large demographic that can be attracted to digital-first fintech products and services. In the United States, the millennial and Gen Z population represent 40% of our population. Megatrend 3, favorable regulation across jurisdictions are acting as tailwinds for the growth in the fintech ecosystem. As an example of that is the National Bank Charter for Fintech Companies, which allows for a more streamlined approach to licensing. Also, many states have developed regulatory sandboxes, which allow fintechs to test their products. And we expect such regulatory steps to continue to facilitate the creation of the new financial ecosystem. The last megatrend was COVID introduced change in the consumer behavior is turning out to be an inflection point for the industry. COVID forced a huge population of traditional, non-digital financial service customers into the digital economy. To transact in a new digital economy, consumers are turning to fintech solutions. And as we know, COVID caused massive changes. Digital innovation was needed quickly and adopted out of necessity. And now we feel the adoption curves are forever changed. This next section is the highlights from some of the important developments of 2023. The biggest development this year is the institutional acceptance of crypto and blockchain technology. BlackRock, Bitcoin ETF application under review at the U.S. Securities and Exchange Commission. Approval will drive institutional adoption even higher. Institutional adoption of digital ledger technology jumps. A survey by Citibank reveals that 86% of institutional investors expect to adopt digital assets and DLT in the next 5 years. The main drivers are, of course, efficiency, transparency, and security. The last point is the stablecoin market is expected to soar to almost $3 trillion in the next 5 years. Bernstein has predicted that the stablecoin market will grow to almost $3 trillion in the next 5 years and potentially disrupt the traditional payment space. Crypto investment by institutions is growing. In a survey by Goldman Sachs, it showed 26% of family offices have invested in cryptocurrency in 2023, and this is up from 16% in 2021. In another sign of institutional acceptance of ledger technology, a recent survey revealed that institutions are expected to allocate 5.6% to tokenized assets in the next 2 years, up from 1%. The buy now, pay later segment is rebounded, has bounced about saying half of the customers are now using it more frequently than a year ago, with 56% of consumers using the service over the past 12 months in surveys. Another financial subsector, neobanks or digital banks, is gaining traction across the globe, offering customers the digital platform that support the demographic shifts we talked about, also supporting our thesis that traditional banking will fall behind the fast-moving digital banks. Artificial intelligence adoptions grows in many use cases, adoptions in the subsector of fintech, but fraud detection has been a focus of the payment companies and banks. We're watching this adoption closely for new developments. My last slide here just shows the trends over the last 2022 and 2023 of funding and activity in the fintech capital markets after a very robust 2021. We're expecting this to continue in the first half of next year, but this will present us a nice opportunity later in the year to buy these companies at reduced prices. So let's review some of the performance for the different subsectors of fintech this year. This is also a review of the stocks we are currently following them in the fintech space. So let me start by reviewing this chart because the following charts are going to have the same format. So in the first 3 columns, you're seeing the stock market performance, the stock performance of these different subsectors. Across this section is the expected revenue growth for 23, 24, 25. And in this section is the expected earnings growth in 23, 24, and 25. When we look at the subsectors or segments of fintech this year, stock price performance goes to the digital banks, lending and mortgage tech, as well as insurance tech at 20%. While the most analysts expect digital banking and payments will experience the most growth in sales and earnings. So we'll start with digital banking. In this group, new holdings is expected to really outperform over the near term as far as revenue and earnings growth, according to consensus analysts. Another one, Akamai Technologies, is also worth mentioning as a potential fast grower. The next fastest growing subsector was payments. The payment sector, along with digital banks, is also showing solid growth potential. And this is across all the companies we follow. And we are highlighting Shift4 payments in the last section of our presentation. Next is the leading lending and mortgage tech subsector. In this group, both Appfolio and Affirm Holdings stand out for both recent stock performance as well as their earnings, their revenue growth estimates. However, earnings growth has yet to materialize here, which means this is a potential for a stock market volatility in any bear market. InsurTech offers 2 companies with solid revenue and earnings growth, Arthur Gallagher and Company and Brown & Brown Inc. In information services, both MSCI and FICO offer solid expectations for growth in the coming years. In capital markets and wealth tech, this sector is dominated by well-established players in the space, including the Chicago Mercantile Exchange, NASDAQ. But we have highlighted in this section one of the new companies, Coinbase, which will be later focused in our last section. of this presentation. In our last subsection, this is traditional banking, and it's important to point this out. You can see that earnings expectations and revenue growth expectations for these banks over the near term is poor at best, and it's consistent throughout the whole entire group. All right, so I'm going to flip to the analyst spotlight and the three companies and it's two companies and one cryptocurrency that I wanted to bring to your attention. The first is Coinbase. It's a leading cryptocurrency exchange and wallet platform with presence in over 100 countries, 76 billion quarterly trading volume, and 114 billion in safeguarded assets. This is differentiated from other crypto exchanges through the focus on security and compliance. Third quarter 23 revenue stood at 623 million versus 576 million, driven by growth in the subscriptions and services revenue. Growth strategies focused on adding assets and payment rails, improve the advanced trade, international expansion, as well as recently launching in Canada in August. They have a strong balance sheet with 5 billion in cash and equivalent, along with customer accounts and USDC. With the adoption of cryptocurrency and ledger technology outlined earlier in the presentation, we believe this benefits Coinbase. This is a leading cryptocurrency company in the United States with competitive advantages to benefit from acceptance and growth of institutional participation. They have state-of-the-art security and compliance, as well as a wealth of institutional settlement offerings that are very attractive to make it easy for new institutions to enter the space. As mentioned earlier, the next company is Swift for Payments. They're redefining customers by simplifying complex payment ecosystem across the world. Powers billions of transactions annually and hundreds of thousands of businesses in everyday industries. Their cloud-based restaurant point-of-service offering, SkyTab, is a big success. They effectively used capital allocation in their recent purchases of Appetize and Finaro. They also had a tremendous third quarter, growing end-to-end volumes 36%, 23% gross profits, 34% growth revenue, less network fees, 24 versus 24% in Q3 22. Swift Payments is a small cap, fast growing company in the payment space, and it does tend to be more volatile in bear market environments, but offers superior growth in the payments arena. Lastly, I'm going to talk a little bit about a cryptocurrency, Chainlink Labs. Chainlink is an Ethereum-based token that powers the Chainlink Lab Oracle network. Chainlink facilitates secure and reliable integration of real-world data into the blockchain platforms. Products range covers cross-chain communication, data, and computation. Uses case ranges from financial services, DeFi, gaming, NFT collectibles, climate markets, enterprise, and insurance. Chainlink facilitates secure and reliable integration of real-world data into the blockchain platform. So what that means is Chainlink Technologies is the way for the blockchain to receive data from the real world that triggers events on the blockchain. There's a wide variety of use cases, as we named recently, but they recently announced a project with DTC, which is the back office security clearing system in the United States, and SWIFT, the international bank messaging system, to use Chainlink's protocol to communicate on the new DTC blockchain. The new token gets minted by DTC, represents bonds and treasury offerings, and is using Chainlink to facilitate the movement to SWIFT designated wallets. This is just one of many, many use cases. And you can check out more information on this in our latest newsletter that came out last week. So in finishing up, I wanted to point out that everything in this presentation is covered in our research over the past few months. We started covering this sector in May, and we have continued to point out and just started to point out the opportunities in this sector. We have 13 research pieces that are out there that cover all of the things that I just mentioned here. So I'm looking forward to detailing that further And that's a wrap. If there's any questions, I could answer them now, Lorenzo.
Got it. Thank you. And can you give us your view on the possible rate cut next year and how is that going to impact the fintech and the financial market? Thanks.
Sure. To go along with the recessionary outlook that I'm expecting, I do expect rates to be cut along the same time frame, starting probably March, April, May timeframe. I do believe that the Fed is going to move slower than they have moved in the past because of all the times that they have been saying higher for longer over the last few weeks and months. So I think they're going to be reluctant to move quickly. And that's actually going to be probably detrimental to stock prices overall. Generally speaking, lower as interest rates go lower, it really does help technology names. So what I'm expecting is initially in the first part of maybe the first quarter to maybe into the April-May timeframe, that this will affect stock prices negatively going forward. And that's kind of why I went through that whole subsector of all the companies we're looking at, because I believe that these will become very attractive purchases come later in the year after that period of time. But as rates decline, it will accelerate the technology names, and I think will offer us a really good opportunity for the second half of 2024.
Got it. Thank you. And you mentioned about favoring the tech names. And how do you compare with the fintech and the more traditional techs if we are having rate cut next year? How do you see the pros and cons in those names?
Well, the fintech market was certainly more affected by the rate rise than the tech market, being the big mega tech stocks. The FANG stocks continued to move up even with the interest rate environment, where fintech technology names being slightly smaller cap, less known, et cetera, did struggle for part of the year. But I do believe that as we kind of go through this recession into next year, I think the fintech market will start to outperform some of the larger names, especially towards, like I said, the second half of next year. So I'm expecting that the market will broaden out, unlike what I was showing to you just before, where we just had a rally off of the 2022 lows that really did not have a lot of participation in it from most of the major players. I think this next move that will probably be, starting sometime in the second half of next year, will have a lot more participation, which should give us a lot more excitement in the fintech space.
Understood. Thank you. And one more, typically, fintech and crypto is very sensitive to the regulatory movement. And how do you see that regulatory change going forward, or how is it likely to change that can impact the future performance?
Well, we had one major event that I didn't mention in my presentation, and I probably should have, which was that Ripple was sued by the Securities and Exchange Commission, and the Securities and Exchange Commission lost their case and did not prove that Ripple was a security. I believe when that happened, there was an obvious movement in the Ripple cryptocurrency, but there was also, I think, a level of relief from the institutional community about the SEC's position on these cryptocurrencies. And between that case and the case that they have with Coinbase, I believe that this will be settled pretty quickly as well. But I think the regulatory environment is getting much more friendly. As I pointed out earlier, with the advent of some of the states that have developed technologies that help these companies move into the space and develop their products and bring them to market faster, as well as the banking regulations that have become easier for these different companies to launch their products as national banks as opposed to getting a charter bank in every state. These are meant to be enhancing the availability to these new companies. In addition to the fact that the Securities and Exchange Commission lost their case and seemed to be very close to approving the ETFs for cryptocurrency, both in Bitcoin and Ethereum, I think the regulatory environment in the United States is starting to get much more friendly for those particular pieces of fintech.
Understood. Thank you. Yeah. And if we have further questions, can we connect with you via emails or via link with Peter?
Absolutely. Yes. So my email is on the screen. My phone number is on the screen as well. So yes, you're welcome to email me any questions. And if anybody wants a copy of some of the work that I put to and some of the charts, I could send a copy of the presentation as well.
Lovely. Okay. Thank you so much for your insightful session, and we look forward to speaking with you again.
Thanks, Lorenzo.
Thank you. Appreciate it.